What if I told you that a simple $1,000 investment in Apple 10 years ago could have turned into over $10,000 today? That's a 900% return on investment, a number that's hard to believe, but true. Apple's journey from a tech underdog to a trillion-dollar giant is one of the most incredible stories in the stock market. But here's something even more surprising. Apple's growth wasn't just about iPhones and Macs. It's about strategic moves, smart decisions, and the power of holding onto a great investment. Did you know that Apple has returned over $550 billion to its shareholders in dividends and buybacks since 2012? That's more than the GDP of some countries. In this video, we're diving deep into what made Apple such a golden opportunity. We'll explore how value investing principles played a crucial role, how Apple survived market storms, and the magic of compounding returns. We'll also look at the risks and rewards of holding onto a stock like Apple, and whether it's still a good buy today. Ready to discover the secrets behind one of the most successful investments of the past decade? Let's get started. Chapter 1. The $1,000 Apple Experiment. A decade-long journey. Imagine if you had invested $1,000 in Apple 10 years ago. Back then, Apple was already a household name, but no one could have fully predicted its growth. Today, that $1,000 would be worth over $10,000. That's a staggering 900% return. It's easy to look back and think, I should have invested. But the real lesson lies in understanding why Apple succeeded and how value investing strategies can help spot opportunities like this in the future. Value investing is all about finding stocks that are undervalued by the market. It's not just about buying cheap, it's about buying quality at a good price. Back in 2013, Apple's stock was trading at around $60, adjusted for splits. Many thought it was too high after its initial growth spurt. But value investors saw something different: strong fundamentals, a loyal customer base, and innovation that kept setting Apple apart from its competitors. Warren Buffett, one of the greatest value investors, once said, "Price is what you pay. Value is what you get." This quote rings true when we look at Apple. Investors who understood the company's intrinsic value beyond its stock price knew that Apple was more than just an iPhone maker. They saw a company with a visionary leader, a brand that people loved, and a pipeline of innovative products. Apple's success wasn't just luck, it was the result of strategic choices and strong execution. In the early 2010s, Apple made key decisions that fueled its growth. For instance, Apple's move into services, like iCloud and the App Store, diversified its revenue streams. This reduced its dependence on hardware sales, which is crucial in the tech world where trends can shift overnight. Moreover, Apple's commitment to returning value to shareholders through dividends and buybacks played a significant role. By 2023, Apple had returned over $550 billion to shareholders through dividends and buybacks since 2012. That's more than the market cap of many Fortune 500 companies. But it wasn't all smooth sailing. Apple faced intense competition from rivals like Samsung and Google. There were also concerns about whether Apple could continue to innovate after Steve Jobs' passing. Yet, Apple didn't just survive, it thrived. Its ability to adapt and keep its loyal customer base allowed it to maintain its market leadership. Investing $1,000 in Apple a decade ago wasn't just about seeing the potential in a single product or service. It was about recognizing a company's long-term strategy and its ability to grow despite challenges. This is the essence of value investing: looking beyond the obvious and finding value where others might not see it. Take a moment to subscribe, and we'll get right back into the video. Chapter 2. Surviving Market Storms. How Apple Weathered the Financial Tempests. Investing in Apple over the past decade wasn't just a walk in the park. The stock market, as we know, is a roller coaster. But what's fascinating is how Apple managed to not only survive but thrive through some pretty rough patches. In 2015, the global stock market faced a significant downturn, with the S&P 500 dropping by about 12% from May to August. Apple wasn't immune to this. Its stock fell by 14% during that period. But instead of panicking, savvy investors held on. Why? Because they believed in Apple's resilience and long-term vision. This is a classic value investing move, sticking to your guns when the market goes haywire. Another example is the trade war between the US and China that started in 2018. Apple, being heavily reliant on Chinese manufacturing, was in the crossfire. Concerns about tariffs and supply chain disruptions caused Apple's stock to drop by over 30% in late 2018. Many investors were worried, but value investors saw this as a temporary setback, not a permanent decline. They understood that Apple's brand strength and loyal customer base would help it bounce back. And they were right. By the end of 2019, Apple's stock had not only recovered but had hit new highs, demonstrating the company's ability to navigate through global uncertainties. This resilience is a key factor in why long-term investors, particularly those following value investing principles, continued to hold or even buy more Apple stock during the downturns. One unique fact about Apple's market strategy is its focus on vertical integration. Apple controls almost every aspect of its products, from design to retail. This gives it a significant competitive advantage, especially during economic downturns. While other companies struggled with supply chain issues, Apple's tight control allowed it to maintain quality and meet customer demand, even when the market was unstable. A quote from Ben Graham, the father of value investing, sums it up well. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. During the market storms, Apple's true value, its innovation, brand loyalty, and operational excellence, continued to shine through, even when the stock price didn't immediately reflect it. So, while the market was casting its votes during turbulent times, those who invested based on the true weight of Apple's value saw their patience rewarded. They didn't just survive the storms, they came out stronger on the other side. Chapter 3. The Power of Patience. Compounding Returns in Action. When it comes to investing, patience isn't just a virtue, it's a strategy. The concept of compounding is simple but incredibly powerful. Albert Einstein famously called compounding the eighth wonder of the world. He wasn't exaggerating. If you had invested $1,000 in Apple a decade ago, the magic of compounding would have turned that into more than $10,000 today. That's not just growth, it's exponential growth. Compounding works best when you give it time. The longer you stay invested, the more your returns can grow, not just linearly but exponentially. This is because you're earning returns on your initial investment and on the returns you've already earned. It's like a snowball rolling down a hill, gathering more snow as it goes. In the case of Apple, the company's consistent performance and reinvestment in its own growth created a perfect scenario for compounding. Apple didn't just sit on its cash, it used it to innovate, acquire companies, and improve its products. This reinvestment paid off, contributing to the stock's consistent rise over the years. Here's a fascinating fact. Apple's total shareholder return, TSR, over the past decade was around 1,000%. TSR includes dividends and stock price appreciation, showing how much value a company has delivered to its shareholders. That's the power of compounding at work. But compounding isn't just about holding onto a stock. It's about holding onto a good stock. Warren Buffett once said, "Our favorite holding period is forever." This quote is particularly relevant when talking about a company like Apple. Long-term investors who trusted in Apple's ability to innovate and dominate its market were rewarded handsomely because they understood the value of patience. It's also important to note that compounding doesn't eliminate risk. Markets go up and down, and individual stocks can have rough patches. But by staying the course and allowing your investment to grow over time, you give yourself the best chance to benefit from compounding returns. For example, if you had sold your Apple stock during one of its dips, say in 2016 when it fell by about 20%, you would have missed out on the massive gains that followed. Value investing is about seeing the bigger picture and not getting shaken out by short-term volatility. It's about trusting that a quality company, like Apple, will continue to grow and deliver returns over time. So, what's the takeaway here? If you're a value investor, you need to embrace the power of patience. Compounding can turn a modest investment into a significant nest egg, but only if you give it time to work. Apple's decade-long growth story is a perfect example of how patience, combined with a sound investment strategy, can lead to remarkable financial success. Chapter 4. Beyond the stock price, dividends, splits, and Apple's growth engine. When people think of Apple's success, they often focus on its stock price. But there's more to the story. Apple's strategy of returning value to shareholders through dividends and stock splits has played a crucial role in its appeal to value investors. Let's start with dividends. Apple began paying dividends in 2012 after a long hiatus. Since then, it has paid out billions of dollars to its shareholders. For example, in 2023 alone, Apple paid out nearly $15 billion in dividends. For long-term investors, these regular payments are a way to earn income without selling their shares. This is a key part of value investing, earning a return on your investment while still holding onto it. Dividends also signal something important about a company's health. When a company like Apple pays regular dividends, it's a sign that it's generating enough cash to reward its shareholders while still investing in its future. This is a big plus for value investors, who are looking for companies with strong fundamentals. Now, let's talk about stock splits. Apple has split its stock multiple times, most recently in 2020 when it did a 4-for-1 split. Stock splits don't change the value of your investment, but they do make the stock more accessible to a broader range of investors. After the 2020 split, Apple's stock became more affordable, attracting more retail investors. This increased demand can lead to a higher stock price, which is exactly what happened after Apple's 2020 split. A unique fact here is that Apple's stock splits have a history of being followed by strong performance. After its 2014 7-for-1 split, Apple's stock rose by nearly 36% in the following year. The 2020 split saw a similar trend, with the stock gaining around 80% in the next 12 months. But dividends and splits are just part of the equation. Apple's real growth engine has been its ability to innovate and expand into new markets. The company's move into services, like Apple Music, Apple Pay, and iCloud, has been a game-changer. These services now contribute significantly to Apple's revenue, providing a steady stream of income that isn't tied to hardware sales. In fact, Apple's services revenue has grown from $4 billion in 2010 to over $78 billion in 2023. This shift towards services has not only diversified Apple's revenue but also created a more predictable and recurring income stream, which is highly valued by investors. Benjamin Graham, the father of value investing, once said, "The individual investor should act consistently as an investor and not as a speculator." Apple's strategy of combining dividends, stock splits, and innovation has created a solid foundation for long-term investors. It's not about chasing the next big thing but about building a strong, sustainable business that delivers consistent value over time. So, while the stock price gets the headlines, it's Apple's underlying strategies, dividends, stock splits, and a focus on services that have truly driven its growth. For value investors, these are the factors that make Apple a compelling long-term investment. Chapter 5. The road not taken. What if you'd sold early? Imagine the temptation of selling your Apple stock when it first doubled or tripled in value. After all, cashing out when you've made a profit seems like the smart thing to do. But what if you had sold too early? This is a question every investor grapples with, especially when they see big gains. However, value investing teaches us that selling too soon can sometimes be the biggest mistake. Let's say you invested $1,000 in Apple in 2013, and by 2015, your investment had doubled to $2,000. It's understandable to consider taking your profits. But what if you had held on? By 2020, that same investment would have grown to over $8,000. Selling early would have cost you $6,000 in potential gains. That's the risk of letting short-term thinking interfere with a long-term strategy. The key here is understanding the difference between price and value. Price is what the market sets, and it can be influenced by emotions, news, and short-term events. Value, on the other hand, is what the company is truly worth based on its fundamentals. As Warren Buffett wisely said, the stock market is designed to transfer money from the active to the patient. Those who were patient with their Apple stock saw their wealth grow exponentially because they understood the value of patience. It's also important to consider the opportunity cost of selling early. If you had sold Apple in 2015, where would you have put that money? Finding another investment with Apple's growth potential would have been challenging. This is why value investors often stick with companies they believe in, even when the stock price rises quickly. Another unique fact is that Apple's stock faced significant volatility over the years. For example, in 2016, Apple's stock dropped by nearly 30% from its peak. Many investors panicked and sold, fearing the worst. But those who understood Apple's long-term value held on, and the stock quickly recovered and soared to new heights. It's also worth noting that Apple's business model evolved over time, making it even more valuable. In the early 2010s, Apple was primarily a hardware company. Today, it's a diversified tech giant with significant revenue from services, software, and wearables. This transformation made the company more resilient and less dependent on iPhone sales, further increasing its intrinsic value. Enjoyed today's video? Subscribe to stay updated on all our future posts.